In this lecture we are going to explore the central element of risk management, which is the risk-reward ratio. The risk-reward ratio is simply the ratio between how much a trader risks and how much he expects to earn in a given trade. In other words, the ratio between the stop-loss order and the take-profit order. By the way, this is one of the reasons it is important to know your targets before you enter a trade. If you don't have any idea where your target might be, you cannot define the risk-reward ratio of your trade, and therefore, you cannot judge if such trade has enough headroom to become a high-quality trade. The risk-reward ratio is so important because it guarantees that we will expect to earn more than what we risk not only in each given trade, but in the long term as well, which is really critical. This brings us to the concept of expectancy, which can be defined as how much a trader can expect to earn in each trade based on the average risk-reward ratios of his past trades. This is why some modes of trading that completely dismiss risk-reward ratios easily fall apart over time. For example, a trader who is after immediate and small rewards and moves his stop-loss a lot to accommodate his biases is silently producing an expectancy lower than 1. This is a deadly mistake for a few different reasons, but the most basic one is that mathematically and statistically speaking, all this trader is doing is expecting to earn less than what he risks, which obviously makes him lose money in the mid and long terms. There is also a severely toxic psychological feature attached to this type of trading because, in the short term, this trader will feel great about his small and subsequent rewards. He will feel like he is really building something great. The problem is that a trader cannot go around the laws of mathematics, so in the mid and long term, it becomes less and less likely that this trader will be able to maintain a high win ratio. In fact, there is too much hype around the idea of win ratios. As you will find out in this course, a trader can make money being wrong most of the time in his decisions, as long as he maintains other aspects of the strategy intact. Before digging deeper into the study of how risk-reward ratios function and their amazing mathematical attributes, let's solidify the idea of expectancy first. Once again, the expectancy of a trading strategy is the average of the risk-reward ratios used in all past trades. For example, in these two tables you can see the risk-reward ratios used in the last 5 trades of 2 trade samples. If we discover the average of these ratios, we will arrive at the expectancy of this strategy. Notice that in Table 1, the strategy uses ratios that range between 1 to 3 and 1 to 5. In Table number 2, the ratios are below 1 because the trader has no real rules on how to manage risk and basically improvises his stop and target decisions based on instinct, which is a really bad idea as we will study later in the trading psychology section of the course. If we take the average of both tables, we can see that Table 1 has an expectancy greater than 1, and Table 2 has an expectancy lower than 1. All this means that the trader using the strategy number 1 can expect to win more in the long term. Meanwhile, the trader producing the strategy number 2 can expect to make less than what he is risking in the long term. In other words, he can expect to lose money in the long term. However, there is a cynical catch at play here. In the beginning of both strategies, both traders will have completely different mindsets. Trader number 1 will probably be a little disappointed because his win ratios won't be that great. However, trader 2 will be building his confidence to dangerous levels due to the high win ratio of his strategy. This is a very misleading exercise. Trader 2 is not aware that his high win ratio only exists because his targets are too close to his trade entries and his stops are too far away. This configuration tends to produce a high win ratio in the short term, but it is doomed to fail over time because, at some point, the market will go against trader 2 and he will be stopped out. That will wipe out most of his small profits and he will be emotionally devastated. On the other hand, if trader 1 is capable of being mature enough to know that a high win ratio is not necessary to make money in the long term, he will continue on his path to become consistently profitable over time. This is a perfect example of what trading really is. This is also a lot like the old story of the tortoise and the hare. The hare is too fast, and it burns itself out too quickly. The tortoise slowly but surely gets where it wants to go. That does not mean that trader 1 cannot have peaks of performance. The better the performance, the better it is for your capital of course, but high performance must occur within a certain framework that will guarantee its sustainability in the long term. After all, nobody starts trading with the goal of making money quickly, and then losing it all even faster. The bottom line regarding the notion of expectancy is that your expectancy level should be higher than 1. For this lecture, it is important that you understand how the idea of risk-reward ratios dwell at the heart of risk management, and how it affects the trader's behavior in the short and long terms. In the next lecture, we are going to look at the margins of error that risk-reward ratios provide, and we are going to define the best range of ratios in which you should maintain your trades.